The Federal Reserve is officially flying blind now. In an unprecedented move, the Bureau of Labor Statistics has canceled the October jobs report. They say that the data could not be collected due to the government shutdown. And that means that the Feds head into the final meeting of the year with a black hole where the economy should be. Now, if you look at this, the FedWatch tool shows markets are betting nearly 70% that the Fed will take rates down to 3 3/4 range and a 1/3 chance to go even lower. In other words, the market is screaming the Fed is done and rate cuts are now the base case. But while the government turns off the lights, the panic is visible. Fed minutes released just yesterday revealed a lot of dissent within the central bank and also a sudden emergency decision to stop quantitative tightening on December 1st. But as they are turning the liquidity taps back on, the question is why? And it seems like it's because the plumbing is breaking. Now we're looking at a market of illusions. Target shares have collapsed, signaling the death of the consumer. But Nvidia just released massive numbers here, beating expectations. But if you look at it, the insiders are selling. And in Washington, reports are surfacing of heated internal clashes at the highest levels over an $8.5 trillion debt hole. All right, to understand this chaos, you don't need an economist. You need a historian of market crashes. Our guest today is a legend in this industry. He called the crash of 1987 weeks in advance. He predicted the dot-com bust back in 2000, and he warned his clients ahead of the 2008 financial crisis. And in September, he sat in this chair on this show and told us that the BLS numbers were a lie. And today, those numbers have vanished entirely. He's here now saying that we're entering a deflationary depression unlike anything we've ever seen since the 30s. Bert Dohmen, of course, founder of the Wellington Letter. Welcome back, Bert. Good to see you.
Nice to be with you again. I love being on your show.
Thanks, Bert. I appreciate that. And what a day it is to kind of cover. I mean, obviously, we got lots to get into. I want to start with that BLS blackout because you've called them for years the Bureau of Lying Statistics. You know, I guess not even years. It's been decades, Bert. Now, they aren't even lying. They've just gone silent here. Is this incompetence? I mean, we know that the government was shut down. Or is this kind of a convenient blackout right before a critical policy decision?
Well, probably the latter, but I think we're all better off without these bad statistics because they are lies. We always pointed out that they are. And you could even find out what the true numbers were by going to the BLS website. You know, It's amazing on their own website. But you have to look hard. You can find the real numbers, and you want to look at the seasonally non-adjusted numbers. They lie with the seasonal adjustments. They have never divulged to any economists who requested, how do you do these seasonal adjustments? They've never said that. And I said, they probably do it by calling the White House chief economist and saying, what number would you like for jobs this month? You know, and that is their analysis. So right now, I think this is a benefit to all people. Because now they're forced to go to the private services like Challenger and so on, and get the real numbers, much more accurate numbers.
Yeah, well,
and the ADP is very good.
I'll tell you one thing. I mean, while everyone seemed to be focusing on the missing jobs report, the Fed minutes dropped kind of a bombshell. On page 15, this is a quote: the committee will conclude the reduction of security holdings on December 1st. So, Bert, I mean, to anyone who understands sound money, this looks like a panic signal. Why stop QT now unless something in the bond market plumbing is seizing up?
Well, that is another lie, in my opinion, at least, that they have been practicing QT. Yeah. This is their definition. You know, the politicians and people in Washington, they make up their own definitions of words. You know, we know that from the COVID vax, you know, they said it was a vaccine. I said, no, mRNA can never be a vaccine, you know, and we wrote that because I know an mRNA for about 20 years. And now we know, mRNA was not a vaccine. It was totally ineffective. And in fact, it killed a few million people. So, you know, all these things are definitions. So what they call QT, during this time, we point that out in every issue of the Wellington Letter, bank loans. When bank loans are rising and you have money supply, M2 rising, that means that you have loose money. They can't rise if there's tight money. They cannot rise. So they have their own definition. And I think of what it is that when they're buying bonds and retiring treasury bonds, they call that tightening. And when they're not buying them, they call that loosening. And I think that's a total misdefinition.
So are you so are you kind of saying that the QT is a lie, that despite the headlines, money supply and bank loans are rising and the system is still being flooded with liquidity? So what's the Fed actually doing? Are they just tightening on paper but loosening in reality?
Yeah, this is loose money. The stock market tells you that.
Yeah.
The market does not go up when there's tight money. The market is empowered by the loose money from the Federal Reserve. This is why the market is now at an all-time high on the basis of valuations. The highest valuation or misallocation of the capital is right now. And you don't have that when money is tight. You have that when money is excessively loose. That's what we're having right now.
We got to talk about the elephant in the room then, because we just got these numbers out of Nvidia. They guided for $65 billion in Q4 revenue, a massive beat. So let me ask you directly. I mean, if you are a bear, how do you argue against the number? Is AI the one thing still holding up the economy?
Yeah, being a bear or being a bull, it all depends on the time frame. Are you talking about? I mean, now it's incredible. People call the long term a couple of weeks. These are the neophytes. Usually the guys they're 20 years old. They just start trading, and they're day traders. So they think with their laptop they can outperform the high frequency trading, which can enter 90,000 trades, not shares, but trades per second. You cannot do that with your laptop, but they think they can. So, you have to stop the short-term trading. I used to be a great short-term trader. I still have an all-time record for option trading results with actual money. And I stopped doing it because now you cannot out-trade these high-frequency trading and the algo traders. So you have to have a different time frame. So we always adjust according to what the market requires. And if you're a good chess player, you can play this game very well because you can figure out what they're doing. They are playing a game of chess, and when you play chess, you always want to put your opponents in a trap. So that's how you win a chess game. So they are so good and putting all the fools, the part-time people into these traps, whether it's a bear trap or a bull trap.
So Bert, when you're saying that the algo are playing chess, what do you mean? Are these machines kind of front running every move, every headline, every liquidity shift, and are the human investors basically the pawns now? I mean, who's holding the bag?
The bag holder. The bag holder always holds the bag, and the bag holder is the retail investor.
Yeah.
That has always been true, but now it used to be maybe, by the best estimates, maybe 60-70% of the short-term trades were like that. Right now, I think we're very close to 100% of the trades are there to fool the majority. They see if the majority of the retail traders are long, they knock the market down. This is how we forecasted, for example, at the beginning of November. We had been looking for a good November and December in our September issues. And then the first issue in November, we said, we have to cancel that forecast for November. November is going to be a big downward correction in the market. All the people and the hot stocks are going to have a big, nasty surprise. And we're going to have a big correction. We're having the correction now. Many stocks are down 20%, 30%, and so on. And Bitcoin is in fact leading it, which is another prediction we made. We said the Bitcoin will lead the markets into the abyss over the next year. The markets will have a very serious problem next year, and it will be led by Bitcoin.
I recall you bringing this up actually back in September too. I want to get your Bitcoin prediction because it kind of goes with that money supply you were talking about. Before we do, on this AI trade, I just got to ask you, this whole, this circular financing thing, tech giants giving cash to startups just so that those startups can buy chips from them. It's like giving your friend money to buy lemonade from your stand and, calling it revenue. I mean, is this an Enron, an Enron moment for AI? What are your thoughts on this? You've been through things like this before.
Yeah. Well, this is the same thing. Everybody's trying to game the markets, and these tech billionaires, they're very good at that. That's how they got to be billionaires. They're starting with nothing. And so right now, this is another signal that this market is ready for a serious down move. But it's not going to happen this year, I don't think. 2026 is probably going to be the year where a lot of people, because I see retail investors buying ETFs that are leverage ETFs. I've been warning in every issue. We say, don't be leveraged. Don't buy leverage ETFs. But I see people doing it anyway. Oh, well, what the heck? We know how to make money. If a stock goes up 10% and we have a 2 times leverage one, it goes up 20%. That's not true at all. For example, here's a stock that everyone knew, and I think was up 28% for this year until early November, 28%. And the ETF, the bullish ETF, okay, was down 68%. Down 68%. Yeah. So the stock itself that you thought you were investing in, this was one stock ETF, went up double digits, and you lost 68% of your money, thinking you would now have a triple or quadruple gain. We now have a new ETF that's come out. It's 4 times leverage. That means if the components go down 20%, the ETF is done. The value of that ETF is zero. Now, people are actually buying this stuff. When you have to watch these podcasts, if anyone doesn't believe me, then they should watch on YouTube. There are several very good podcasts about 1929, and they have nothing to do with Sorkin's book. I hear that's a very good book. But these are podcasts, and it's a very good because you can see the enthusiasm that preceded that top in 1929, and now the speculation has gone above that, above what we saw in 29.
So this is good. I mean, you're kind of, let's start with that warning that 2026 is the year when the real damage kind of shows up. And at the same time, retail investors are piling into these leveraged ETFs that they barely understand. So are we setting up for a scenario where the most inexperienced investors get hit the hardest when this unravels?
Yes, it always is like that. The most inexperienced have the biggest losses, and then it goes up the ladder. If you're a little bit smarter, then you can avoid it. You can hedge your position, or maybe just go into treasury bills. I would not go into money market funds too heavily because they have all kinds of garbage in money market funds. But look at what Wall Street likes to do is put people, sell people the stuff that they don't want anymore. For example, private credit firms, private equity firms. They've been pushed for the last 5 months. Oh, these are wonderful, wonderful. You invest directly in these big companies and so on and so on. No, they're terrible. It's all the garbage that Wall Street doesn't want to have in a bear market. Because in a bear market, they're totally, totally illiquid. Mm-hmm. You can't sell them. Mm-hmm. So Wall Street wants to sell them now. So they put it on financial TV. And then people say, oh, private equity. I got to get into private equity. Yeah. They could. When they call Bitcoin liquid gold, I mean, who are these people? Do they know what gold is? Liquid gold is Bitcoin? Bitcoin is down, 20% here in the last few weeks? Bitcoin and gold is up? I don't understand that people actually fall for this kind of stuff.
So, okay, well, we got to get into the Bitcoin. There's too many things every time you and I talk, Bert. Let's start because we got to go back to gold, and I keep writing it down because there's too many good bits here. But you keep stressing that 2026 is the year when everything kind of breaks. Let's go a little bit deeper. What exactly is the mechanism that you see kind of unfolding next year? Are we talking about a credit event, maybe a liquidity freeze, a deflation shock, or something structural in the system that finally hits its limits?
Yeah, there's so many different things that can go wrong.
Yeah.
And, for example, the world scene is in shambles. We all know that. But Russia now, I mean, we're finally getting to the point where we are kicking Russia so many times that Russia is going to finally give up and say, okay, we got to fight these guys, no more Mr. Nice guys. So we're really, and then you see the situation in the Middle East. I mean, trying to kill 2 million people just to have Gaza empty. There's another reason everybody talks about the Trump resort in Gaza. No, there's a better reason, and that's natural gas that belongs to the Palestinians. It's offshore from Gaza, and this is what Israel wants. Okay, so it's just that simple. But so we have so many cards. Now we're going to make war against Venezuela. Can anybody tell me why? Yes, they have the biggest oil reserves, but much of it is basically tar. It's way underground. It's tar. We have much better oil. Our reserves in the United States are 400 years worth of oil reserves underground, underneath our feet. 400 years. Why do we want to go to Venezuela, have a war to get their muddy oil? Yeah, well, they've got emeralds too, and they've got gold. Maybe that's the reason. I don't know. But it just does not make sense what is happening on the international front. So domestically, we see the speculative fever in all areas. And when speculation gets this insane, people buying SPACs, they're not even allowed to say what they're going to invest the money in. How can you invest in a company that doesn't even tell you what they're going to do with your money? I mean, does this make sense?
Yeah, but Bert,
I don't know. Maybe I'm just old fashioned.
If the U.S. doesn't need Venezuela's oil, I mean, does that mean that the real motive is strategic minerals, influence, geography, or is it simply controlling another piece of the global energy chessboard before the next crisis hits? I mean, what's the real objective being behind this push?
Well, I wonder if anybody knows. And I mean, I don't think the president knows, but there may be some other people behind the scenes that know. The pretext is, of course, drugs, but most of the drugs are coming from our neighbor, which has a long border with the United States. It's called Mexico. So if we really want to go after drugs, all we have to do is march across the border, and we can control that problem much easier than Venezuela, which is 1,000 miles away.
Yeah, well said. Okay, well, listen, let's get back to your letter, because you kind of had this chapter about the deflationary depression, and I mean, it's kind of your biggest forecast for 2026. 2 years you've warned about inflation, but now you've kind of pivoted sharply. You wrote, quote, "For the first time in decades, we believe there's a serious danger of deflation." Now we're watching China's bond yields drop below Japan's, a historic deflation signal. But you argue that the real U.S. trigger is AI itself, right? I mean, you wrote that the Fed can conquer 8% unemployment, but they can stop 25 to 30%. So, I mean, that is depression level number. Is 30% of the people losing their jobs here? What happens to the housing market? Who pays for the mortgage?
In fact, there's some forecasts from Europe. They're looking at a global unemployment of about 50%. So I don't know if that is too extreme or not, but AI is going to shake up the world. We're seeing it already now with the big layoffs of Google and Amazon, 20,000, 30,000, 15,000 at Microsoft. Microsoft is, reports record sales, record earnings, but then fires 15,000 people. So what is it? It's AI. AI is making people superfluous. So that's what's going to happen. Now, in past revolutions of technology, we've usually had something come along that took up the slack that people can then go into. With AI, that may not happen because AI really takes special skills to get somebody into the AI field. And so who knows if the new jobs that will eventually open up will absorb all the people that are getting laid off now. I think if that happens, it's going to take a number of years before that happens. And in the meantime, you're going to have huge unemployment. Huge unemployment. Unemployment creates deflation. Now, there's one way, the government can, I've been thinking about this. Gold, for example, um, is is a good advantage if you want to be able to continue to sell treasury bonds. Our long-term treasury bonds have not found a lot of bidders lately. But wouldn't it be great if the president suddenly would say, we are going to back all U.S. long-term treasury bonds with gold? Okay. And we calculated that about 20,000 tons, the price of $20,000 per ounce of gold would enable us to back all U.S. Treasury bonds with gold. Now, can you imagine what that would do with the markets? I mean, people would say, wow, here we have a solution for selling treasury bonds. Everybody's going to want to buy treasury bonds because nobody has gold-backed T-bonds, right? And so is that going to happen? I don't know if it's going to happen. I don't have a line to the White House, but that would be something very, very interesting because currently most people don't even know that. The official price of gold that the United States holds is valued at a little bit over $42 an ounce. $42. That's ridiculous. Market price is 4,000. So by revaluing this to a more realistic price, like you could really do wonders to the markets.
Yeah, I mean, if the U.S. actually moved towards gold-backed treasuries, even partially, doesn't that acknowledge the dollar's long-term weakness and the Fed's loss of control? Wouldn't that be the clearest admission yet that the monetary system is kind of running out of road?
Well, Jeremy, everybody talks about the weak dollar. The dollar has not been weak.
Yeah.
It's in an up and down pattern. The dollar is, if you had all the currency of choice, you could put your money into any currency in the world. Okay, would you choose the yen? Would you choose the won? Or would you choose the peso? Or would you choose the U.S. dollar? I would take the U.S. dollar. Wouldn't you?
Mm-hmm. Yeah, what do they call it? The cleanest shirt in the laundry.
Yeah, there you go. Yeah, so I don't see the problem with the U.S. dollar, and especially if we can ever initiate this program that Trump wants to do for long term, making the U.S. the manufacturing haven for foreign companies, having incentives for foreign companies to put their manufacturing in the U.S. Then these companies, they're going to need U.S. dollars to build factories over here, to hire people to do the manufacturing. That creates a demand for dollars. So the dollar would rise instead of decline.
I got to ask you, I mean, if we're heading towards a depression, the chaos in Washington makes sense. In your latest letter, you reported a near physical confrontation between Treasury Secretary Bessent and FHA Director Pulte. You say that the fight is kind of over this $8.5 trillion hole in the FHA portfolio. Bert, is the housing market secretly insolvent? I mean, are the government officials fighting over who takes the blame for the next 2008?
Well, that is the problem. Is the mortgages? People are running out of money. Yeah. I mean, look at credit cards. I recently heard, I think it was last week, somebody said that some credit card companies are charging 40% interest. I can't believe that, but I know true number is 30%. I never heard. That's the first time I heard 40%. But I mean, how can people pay this? If people are going to pay 40%, they must really be in dire straits. So, and the mortgages right now are a big problem. People cannot afford housing anymore. because I have several homes, and I've got one home. The home insurance went from 15,000 a year to 60,000. Okay, well, at 60,000, I said, you know where you can go. I don't need the insurance. I'm going to insure myself. And I know a lot of my neighbors in that gated community are doing the same thing. Because when you have a claim, does the insurance company pay you the fair price? No, they don't.
That's an interesting one. Hey, just on that front, I got to ask you. I mean, you've hinted that the real breaking point isn't stocks. We've talked about this before. It's that mortgages and credits, and behind the scenes, delinquencies are rising, and that FHA exposure you're talking about is exploding, and the private credit market is factually wobbling. I mean, what exactly are you watching in the mortgage and credit system that tells you something serious brewing? Is there anything you look at every day?
Default rate.
Okay.
The defaults on the mortgages. It's rising. I think it's right now at or near an all-time high. So you want to look at loan defaults in all the different areas, credit card defaults, etc. That tells you. In 50 years ago, when I was 1977, we developed what I call a Dohmen theory of liquidity and credit. If you want to know if the market is going to go up over the longer term meaning like the next year, or down, you only have to look at two things: liquidity and credit. Don't forget earnings, forget dividends, forget buybacks, forget all this baloney they tell you on TV. Okay? You only have to look at liquidity and credit. When liquidity is expanding and when credit is expanding, the markets have to go up. And when both are contracting, the markets have to go down because stocks become a source of cash. It's really that simple.
Yeah. Bert, who's benefiting, my friend? I mean, you've been tracking insider behavior for decades, and what we're seeing now is unprecedented. I mean, insiders are dumping shares at the fastest pace since 2007. CEOs are cashing out at record highs, and there's this literally launching this whole GRIFT ETF that tracks politician trades. Are we watching the early stages of what you call the fright economy, where people closest to the system are quietly kind of heading to the exits before the public realizes what's coming?
Yes, we've been calling this the distribution phase. Distribution is a technical term used by professionals in the business, and that means the money goes from the stocks go from the big smart money to the naive retail trader. The retail trader is the backholder. When you think of it, somebody has to hold all the stocks that are outstanding, right? Somebody has to hold them on the way down. When the Nasdaq, like in the year 2000, went down 80%, somebody had to hold it all the way down to 80%. Wall Street obviously didn't want to be the holder, so they elect the retail investors to hold those stocks. So they are the backholders. The retail investors are the backholders all the way down. And at the bottom, you hear the warnings. Oh, it's the end of the world. The banking system is going to close. It's going to be a run on the banks and so on. And this is when the insiders start buying. It's a game. Why not? I mean, look, people go to Las Vegas. Now you can save yourself the airfare.
Yeah. I mean, how do you avoid? We talked about this before, but how do you avoid holding the bag? I mean, people are sitting at home. They hear this. They feel trapped. They can't move the markets. They don't have the research teams. They're not writing algorithms, right? I mean, they're just trying to protect their retirement or savings. What specifically can a regular investor do right now to avoid being that naive buyer that smart money is unloading onto?
Well, I'm really glad you asked that. All you have to do is subscribe to our Bert Dohmen's Wellington Letter. Okay? It's available. The URL is here in the background, Dohmen Capital Research. Actually, the URL is dohmencapital.com. And you will see the services that we have. We also have short-term trading services. But the Wellington Letter is issued twice a month, usually about 25 pages. We never intended to have it that long, each issue. But there's so much to write about. And you get 50 pages each month. and all of that for right now, $750. We're going to have to raise the price pretty soon because everything has been going up, the rent, etc. So we're going to have to raise the price. But this is the best value you will ever find. I know a lot of newsletters out there. There are a lot of good ones, but nobody offers everything that we offer.
Well, listen, I
Because
mean,
it's a overview.
we know for a fact that your readers get the full playbook, Bert. But give the rest of my audience at least one page from it. I mean, if there was the warning signs you're talking about, if you had to boil it down to maybe one actionable step that the average investor can take today, what should they do?
Well, the first thing, it's always the most important thing is what you should not do.
Yeah.
Most people focus on the profit. No, you should focus on avoiding losses. That's much more important because losses are very hard to recover. And so that's the first thing. No leverage. That's so important. So, in the 1987 crash, I remember we had lunch with the vice president from Wall Street. He came to our city, we had lunch, and he said, "Yeah, I've been traveling all over the country and so on." I said, what are you doing? He said, "Foreclosing houses." I said, "I didn't know you were in real estate." He said, "We're not. But these are people that couldn't meet their margin calls." Can you imagine? People lost their homes because they couldn't meet the margin call. Now, I don't know if the law has changed in the meantime, but I thought that was horrible.
Yeah, no kidding.
So
Nobody wants to. I mean,
most important.
There's a lot of leveraged play out there. It's even in the crypto economy.
Yeah. You see, the thing is, as soon as you feel that greed emotion inside of you, just forget it. Close out your positions and go play golf. You don't want to invest with your emotions. And I see it all the time when I talk to people. Oh, God, one person had called, he had a leveraged bear ETF, so supposedly makes money if the markets go down. A triple leverage. I said, hey, do you know how the leverage works against you? Why don't you read some of the articles? They're all online, these articles. It shows you how the math works against you when you have a leveraged investment. It works totally against you. You could be in the right investment and everything, but the leverage, the ups and downs, mathematics works against you. Now, I have a degree in mathematics and chemistry, so I know a little bit about it. The average person is going to have to read a little bit more or maybe read it 3 times. But it's so important to understand that. You have to read. I always tell my 5 grandchildren, I said, if you want to be a leader, you have to be a reader. So, and I think it's the best advice I can give them.
Yeah, Bert, I mean, this is an interesting point because everyone thinks that margin calls start with stocks, but the real danger now may be on the bond side. I mean, if Treasury volatility jumps and long duration paper collapses, won't that trigger margin calls in portfolios that people assume are safe? Is this the first round of forced selling coming from places nobody expects?
Yeah, but it's the professionals who are on the hook with bonds because they use the derivatives and they leverage these things like 2% margin. 2% margin means that if the bonds go down 2%, you've lost everything. But they're doing this because they think they can fix this with other derivatives and hedges and so on. And then we get into situations so complicated. You may remember the book, I think it was The Big Short, about 2008. And there was this one firm, they fired their derivative guy, and he was the only one that knew their exposure to derivatives. And then they panicked, trying to get him back in and said, "Where's our exposure?" And I forgot if he ever came back or not. But the positions that these people, these companies, big companies like the Wall Street firms have, the CEO has no idea of the exposure that they have.
Right. And, to your point, I mean, markets don't crash during the day anymore. They crash at 3 a.m. in the futures market when liquidity is thin and algos control everything. Are you worried that the next margin cascade happens when the public's asleep with the losses already kind of locked in before they wake up?
We wrote that about 6 weeks ago. We said, how do you know that the stock is or a certain sector is going to go down? You know by big down gap openings. Remember the word down gap openings. When the stock opens up, it's down 20%. That means that they don't want to give holders a chance to sell. Because the average investor said, "Oh, I can't sell it now. I'm holding it at a loss." That's the biggest fallacy of most investors. "Oh, I can't sell it because I have a loss." No, the loss is there even if you don't sell it. And so the first loss is the best loss. That is our motto. We all make mistakes, but get out when the mistake is small. You don't let a small mistake grow into a big one. That's
Yeah.
the important thing.
Yeah, it's a good lesson
So
for you maybe to learn to teach the audience too. I mean, but the public might not realize that brokers don't wait for permission. If collateral drops below threshold, they can pull the trigger. Are you worried that, the millions of investors will learn the hard way that their portfolios could be sold out automatically?
exactly. They don't have to ask you for permission at all. But the big thing, I'm glad you mentioned that, the big down gap openings. That is such a big clue in technical analysis. This is done on purpose. This is not market forces. This is manipulation. There is so much manipulation in the market now. I think it's almost totally the short term. It's totally manipulated, and manipulation is supposed to be against the law, but the SEC seems to like it.
Yeah.
So, or at least their friends do. And so, you have to see what reality is. Where billions of dollars can be made in a day, how can you expect it to be fair? You
So,
cannot.
no, yeah. Are you holding cash in this market? I mean, are you doing what some others are doing? I mean, for the people who are sitting on these leveraged ETFs, this high beta tech or even margin, I mean, is the safest move right now simply to step aside until the system resets? Because some say, well, we missed the run up, right? I mean, we missed some of those run ups, but if someone must hold the losses in this distribution phase you're talking about, how do regular investors avoid becoming one of those naive buyers?
Well, why buy when the markets are going down?
Yeah.
The whole thing is you don't want to always be buying. When they tell you on TV, buy the dips, forget it. You are the dip if you do that. You know, don't do it. When the market, see, this is what technical analysis is all about. It tells you when the bear market is starting. And so we can't tell, and we never do tell people buy now and sell now and so on. We say, these are the negatives. We would sell now. We would buy now, but we can't know the emotional setup of thousands of people who subscribe. Some are very antsy, some are very short term, some are very long term. So it's up to them to make their own decision. People hesitate to make decisions. And I was used to ask people for years. Said, "Do you know what is your 401k plan?" Nobody, I didn't find one person that knew what was in their 401k plan. Then I would have, do you know if it's bond market related or stock market? They didn't even know that. So this is how little work the average investor does for his investments.
Yeah.
You
Yeah.
know?
Well,
So how do they ever expect to make any money? When on the other side, there are brilliant people with long experience in the markets. That's it. That's your opponent. Uh, I mean, playing chess. My brother was a chess champion of our state twice. He could play chess blindfolded. He didn't even have to see the board. His opponent would just say the move that he made, and so he memorized the whole thing in his mind, and he would win the games. It was amazing how he could do that. But a good chess player is what you want now. There was a time I remember very well, and I don't know if the Wall Street is still doing it, but the big trend on Wall Street was to hire championship chess players as market analysts.
hmm, hmm.
Yeah.
I got to ask you before we wrap up. We always miss, kind of it goes too fast for us, Bert. But I mean, you were talking about Bitcoin, you were talking about gold. Let's start with gold. And one of the things I want to ask you is I mean, it's trading around 4,000 right now on the spot side. You issued a big warning this week in your newsletter about tokenized gold products like Tether Gold. You wrote we wouldn't touch Tether product. Why? If it's backed by gold, what's the danger?
How do you know it's backed by gold? Because they say so?
Yeah. So that's it? Just because it's, it's another Fort Knox?
That's it. That's it. It's just that simple. Yeah. If I want to sell you the Brooklyn Bridge, wouldn't you like to have evidence that I own it?
Makes sense. So, I mean, you're looking at the Nvidia earnings right now, and you're not beaming with optimism. I got to ask you, because the Fed has cut the kind of data here, and the consumer seems to be cracking. You, in this newsletter, which was what I found really interesting, is you said that there's going to be a possibility, or at least warned of, a year-end rally, and you said that would be the trap if Nvidia, sparked a melt up into December. Is this the final exit ramp, or do we ride this bubble all the way into 2026?
At the beginning of November, I came to the conclusion that we're going to see a negative November, where a lot of the high-flying stocks are going to be hit hard. And so then people get bearish again, and it creates lower prices even for good stocks like Nvidia. Everybody talks to Nvidia is overvalued and so on, but Nvidia has a moat around it. Nobody can get into their business. They've got it all. It's not just chips. It's not just software. They've got it all. So Nvidia is the number one stock. People try to equate it with Cisco. Cisco had one item. It was a router a year ago, and it went up 2,000% or something. But it had a router. How easy is it to duplicate a router? And they found out how easy that was. So anyway, but I think, and then I said we're going to get the good stocks to lower prices in November, and then we're able the big smart money to pick up the stocks again. The HFT, high frequency trading, to pick up stocks for year-end rally in December. So they always create their own opportunities, just like a chess player. They knock the stocks down, then they buy the stocks cheap. Then it comes to year-end rally, which is very predictable because institutional money managers want to hold the right stocks in their year-end portfolio. They don't want to hold the garbage. Okay, so you want to buy the stocks that are good, that anybody can show in their portfolio. Look at the beautiful, valuable stocks that we bought for your portfolio.
Right.
And then comes January, and that's then, of course, all that stuff goes out of the window. And then the HFT once again does what they want to do for everybody. Then is on the long side, they will short the market.
Yeah, interesting.
Yeah. So that's a game. That's a game.
Yeah.
If people think it's fair, they're going to lose. Yeah. You have to realize, people go to Las Vegas all the time to play games, right? The roulette, etc. Here you save yourself the airfare.
If you were to talk to somebody tonight, I mean, that kind of, everyone needs clarity. I mean, most people can't rotate their entire portfolio overnight, right? I mean, if you had to give one final message, one principle that viewers could kind of carry with them onto this increasingly unstable world, what would it be, Bert?
Well, like this year, there was the April 8th bottom, and it was a big plunge in the stock market, which we caught right at the beginning. We said in January and February, we said, get out of stocks, we're going to have a big correction. And we had that correction going into April 8th. But we did not get back into the same stocks. We got back into another sector, which I will not mention, because our paid subscribers deserve some preference. And so the sector that we got into had gains of 130% of one ETF. And so for the year, the rest of the market, you take the gains from February and so on, we're up 6%, 12%, and so on. So way outperformed everything else, with much lower risk. See, that's the important thing. You want to see what's lower risk, what's higher risk. Like, in 1977, 78, actually, I started a company in 77. 78, I made a forecast because the new Federal Reserve chairman said, we're going to fight inflation, not with not with tight money, but with interest rates. And I said, oh, so he's going to raise interest rates, but have loose money. That is a prescription for much higher inflation. We're going to have double-digit inflation. We're going to have double-digit interest rates, and we're going to have stock market going up. And there was the chief economist of Goldman Sachs was having a seminar in our town. And at the end, I made the forecast because he was forecasting a peak at a prime rate of 12.75%. I said, well, we're forecasting 20% peak in the prime rate. And he said, that's absurd. Our markets would never stand for it. And I said, it will if inflation is high enough. And this is going to be high enough. So in 1980, we had 20% prime rate and inflation was 15%. And the stock market had soared. The Wall Street wisdom was when interest rates rise, you got to sell stocks. No, I said interest rates, stocks are going to be the inflation hedge for people. Inflation hedge, because companies can increase prices if you have loose money. If you have loose money, people can borrow the money to pay the higher prices. That was a unique thought, and the Wall Street economists had never thought of that. But it turned out to be true. I'm not an economist. That's a big advantage. It took 2 years. I took advanced economics just to find out why economists are always so wrong, and I found out.
Yeah, well said. All right, well, I'm going to put everyone over to the Wellington Letter. Of course, Bert Dohmen joining us today. Interesting market, Bert. So many things to get into. We appreciate your time again. I encourage the audience to go back and watch our interview from September. I mean, you kind of called a little bit of that top back then, and it's been incredibly accurate. Thank you for your time. I appreciate that.
It's always a great pleasure to be with you, Jeremy. I wish you all the best, and let's do it again soon. I think next year there's going to be so much to talk about.
Yeah, okay? Isn't that the case? Especially if this thesis holds true, Bert. I appreciate that. Happy Thanksgiving and happy holidays to you.
Thank you. Same to you. Okay.
Appreciate it.
All right. Bye.
All right. Now, the signals are flashing red, from the missing jobs report to the FHA fight to the Fed's sudden panic pivot. Now, thank you for joining us here at Kitco News. We're watching for independent analysis. And of course, we're going to be asking some tough questions. Be sure to hit subscribe. I'm Jeremy Szafron for all of us. We'll see you next time.